Welcome to the Slow Money Club podcast, the show giving you realistic ways of attaining financial freedom. We share get-rich-slow strategies to help you go from employee to entrepreneur and turn your dreams into income streams. Now here's your host, Kwesi.
Hello, and thank you again for joining me here on the Slow Money podcast. Now, in this episode, I am delighted to be joined by Kevin Wright. So, Kevin is one of the foremost people in the property sector, I would say, when it comes to finance and his knowledge about different types of finance. In particular, he specializes in bridging, which I know from my own experience when I started, it was probably the type of financial product that I knew the least about, and that's coming from a financial background. So, I'm really glad that he's decided to join us here today, and he's going to share a lot of his knowledge and his experience with you so that you can use it as a template for your own, and so you can use it to accelerate your journey from employee to entrepreneur. So on that note, thank you for joining me, Kevin.
You're very welcome, Kwesi. Very welcome.
Well, so I think to begin with, I just want to start at the beginning, I guess, and if you maybe tell people just a bit more about you and how you started even before property, before finance even. What were you doing? How did you end up in this space?
Yeah, there are some people that have a clearly defined career path, at a fairly early age. You sort of see some people and they said, oh, yeah, I knew from the age of 8 I wanted to be a doctor, or quickly became apparent in my teens that wasn't going to happen. Which is the common experience. So no one sits at school and says, "Oh, well, my ambition is to be a warehouse manager." It's always fireman, train driver, astronaut, or something like that. And then reality kicks in, and we get a real job. So I went through probably a handful of different jobs, and that sort of thing, clerical, warehousing, that type of thing. And then probably at the age of let's see what that had been, about 25, 26. I got my first sales job. At the time, it was working for a company that distributed motor parts. And I got a little company car, Fiesta, because they used to give you company cars back then.
Not bad.
Had a basic plus, the opportunity to earn commission. And I did pretty well at that, really. But I guess I saw the limitations. Well, actually, I had a limitation. And sometimes if people have heard me speak, they'd have seen me different networking events. They might have heard me sort of, give a graphic sort of a description of that conversation where I got pulled into my regional manager's office and told that actually I was being too successful and I was out earning my branch manager. So he was going to put a stop to that by capping my commission. So I can never take home more than my branch manager, which is as motivation techniques go, that's a rather strange one, really.
Yeah, I guess that's one way to put a cap on ambition.
Yeah, that's it. And precipitated the exit from that company. And at the time I found a job that I thought would pay me what I was worth because it was commission only. And it was designing and selling kitchens to the general public. I did that for a few years. That went quite well. And then there was a sort of a big recession and people weren't moving, people weren't buying kitchens. And that made times very hard. So I switched into financial services. Again, basically in a sales or advisory capacity, because I'd learned that I was reasonably adept at interacting with people. And so I went to on a commission-only basis, and promptly in the first year of doing that, quadrupled my earnings.
Oh, wow.
This is doing the designing in the kitchens. But then I moved into financial services, I guess you could say, as an insurance advisor. Did that for 10 years, company shut down. And by that time, I felt I had enough to just go out and start my own business. So essentially doing the same thing with the same clients for providing the same service that my ex-employer was no longer able to because they shut down. And then that morphed from general financial advice into mortgage-specific advice, largely because I felt that advising people put their money in stock market-based pensions or investments, there was a bit of incongruency there because that's not actually what I did and what I would have done with that money. I'd have put it into property. So I thought, well, it's not particularly good to tell people to do something if you wouldn't do it yourself.
Yeah.
So I just pulled out of that side of financial advice and just focused purely on mortgages. Built up a very successful brokerage, pre-Credit Crunch. dealing more and more with investors and the Mortgage Express side of things with the same day refinancing, and I built a very good brokerage. And then it all come crashing down with the credit crunch. Lenders stopped lending, so it messed up property investors at the time, big style. It messed up brokers, big style too. And out of the ashes of that, the phoenix of my current brokerage, which is based around bridging and development finance, that grew to sort of where it is now, where as a brokerage, in recent years, we've brokered hundreds and hundreds of bridging and development deals. And as an educator, I've taught probably getting on for 1,000 people the intricacies of how, and the dark arts, as some people have called it, of bridging finance and how to use it with intelligence. And that's the key, really, because most people don't have the skills, they haven't learned how to use it with intelligence, and therefore it's just viewed as very expensive. But it's an accurate but oversimplistic view of the product.
I think a lot of people are afraid of the risks, or they see it as being risky and expensive. And I'm sure you're going to explain that in more detail to us. But
Sure.
just bringing you back a little bit, you mentioned something that jumped out to me anyway, is you said that you sort of quit your job where you were salaried and on some commission to go for one that was fully commissioned because you felt more comfortable like that. That's quite an interesting mindset, because most people are probably the opposite.
Well, yeah, I guess, that was an unusual thing at the time. I mean, now I was a single guy at the time. So although I had a mortgage, I didn't have a family to support. So I guess that gave me, a little bit more flexibility, but certainly, I had bills to pay and I had a mortgage to pay. And so and incidentally, a thread running throughout most of that period was I was active in property. So I did my first refurb back in 1983, about the time that I got my first sales job. And in one way or another, I've sort of been involved in it ever since. So during that time, I've done flips, I've done single lets, I've done HMOs, I've done new build. So, there's a fair few of the strategies that are relevant now that I've done those.
And so
I've never been in full time in property. Never wanted to be full time in property. Actually, I've always, for the last 25 years, I've been involved in financial services, and predominantly in recent years, in bridging and training, and I get tremendous fulfillment from doing that.
And so back in 1983, when you're working in a commission-based job, what made you decide to go for investing in property, which wasn't necessarily as popular as it is today, that as an investment?
Well, it certainly wasn't, and there was certainly no training courses or resources where you could learn from other people. Two things triggered that, actually. When I first left home and moved into what would now be called an HMO, the landlord lived in, so mirroring what Simon Zucci did with when he first sort of left university. If you've ever heard him tell his story, he bought a house in a part of Birmingham, not too far from Cadbury's, where he was working at the time, and filled the rest of the rooms with tenants who paid his mortgage and bills and effectively allowed him to live for free. Well, I lived with a guy that did exactly the same, probably about 20 or more years earlier than that. And so, I sort of, by living with him, I got exposed to what he was doing, and he'd buy a wreck of a property, do it up and sell it on and make a few £1,000s, and occasionally keep one and rent it out. I thought, I didn't really see how I could do it, but I thought, I've never seen anybody do that before. So that was interesting. And then out of the blue, I got a birthday present from my mother, and it was a book about renovating property. Where she found it, I don't know, and she can't remember now where she found it, but somehow she did. She thought I might like it. And it was called Property Renovation Profits. In the number of years that I've been speaking at property meetings, I've only come across one guy that actually says, "Oh yeah, I remember that. I got a copy of that book."
And who is that by any chance?
Sorry?
Who is that person?
Oh, I met him at York Pin. The name escapes me now. Phil, someone or other. And if he ever listens to this, sorry for forgetting your surname, Phil. But yeah, so
just quickly, I have that book.
Okay, Property Renovation Profits.
Yeah.
Well, it was a sort of a A5 in a,
Yep.
or no, it might have been A4 actually, and a sort of plain green cover, not a jazzed up cover at all. But yeah.
So, funny story. I met someone randomly who mentioned this book. They told me a similar story. I can't remember who it was. And they, yeah, as I think, I really can't remember.
No.
And but they told me a similar story, and after they told me that story, I went and bought the book. But as I'm thinking, I don't even know if maybe I heard you say that somewhere.
Could have been, yeah, could have been, because I've talked about it at various meetings I've spoken about. But yeah, and it's called Property Renovation Profits, and it tells you really how to buy, refurb, and sell a property. It was like a DIY manual, if you like. Not that you necessarily had to do the work. You could pull tradesmen in to do that, but it talks you through the process about, the financing process as was available at the time. And I guess maybe a number of people bought the book, but as is often the case with anything, it's not about what you learn, it's about what you do. And what I did was I took action. So I did buy a property, I did refurb it, and I did sell it, and I did make a profit. And that pretty much launched it all off. So, it was I guess the seed was sown by observing what my landlord was doing. And then, I guess 4 or 5 years later, something like that, got the book from my mother, thought this sounds interesting. It gives me, now I can see how my previous landlord was doing it, and I can do this, and I did it. So, and that sort of got me off on my property journey. And, as most people will have found in property or other things, one thing leads to another, and you progress, and you try different strategies, and see how they work out. But I guess going back to the thing about how would you, how difficult is it to leave a salary and just jump onto running your own business? Well, I guess that depends on how well you were doing in your job. I was doing pretty well in my salaried sales position with commission that ended up being capped. So I guess that gave me a degree of confidence in my own ability.
Yeah, makes sense. And that confidence, I guess, is what you took into your entrepreneurial endeavors, working for yourself ultimately.
Yeah.
Very quickly, actually, the book, Renovating Profit, do you remember who wrote it?
I don't actually. I haven't got it to hand.
No worries. We'll find out.
But we can dig around on that, yeah.
Yeah, and I think it's interesting. So you're doing the property on the side. How did you then manage to juggle both at the same time? Because one of the things people often complain about is not having enough time.
Yeah, that's and that clearly is an issue. And I think it's about good time management, really. And I mean, a lot of people effectively have to burn the candle at both ends if they want to become full-time in property. That wasn't my ambition, and it isn't everyone's ambition, but it is a lot of people's ambition. I think if they've got that tends to be the goal, the objective, if they have a less than fulfilling day job. Day job doesn't captivate their imagination, then they would like to sort of gravitate their way out of it and do something that's more fulfilling and maybe gives them, a better work-life balance. As often I've spoke to people in property, and the guy said, the thing I like best about the property is, if I want to take my children out for the day, I can do. If I want to do the school run, I can do. It gives that element of freedom. Well, so I guess that can be a motivating factor. But essentially, you've got to burn the candle. But if it's actually objective, it's about burning the candle at both ends for a limited period. And for myself, I would have several weeks of intensive action, and then I'd chill out and take a back step. Typically, while the property was being sold, there wasn't much else to do. At that time, with the finance, with the restrictive finance that was around at the time, so you just sort of chill out for a few weeks. So it was, I guess, how I handled it was bouts of activity followed by bouts of inactivity, that allowed me to recharge the batteries.
Yeah, I like that strategy. I think I'll equate that probably to something called Agile methodology, which is a project management methodology where you have sprints. So you basically have a series of tasks that you want to do, and you do them over what are called sprints, maybe for 3 weeks, 6 weeks. And in that time, you do lots of stuff, but then after that sprint is over, you then kind of take a bit of a break, look at the landscape, see what's happened, and then plan your next
Yeah,
sprint. But yeah, that sounds pretty
yeah,
much like what you described.
yeah. I'd say that's a a very accurate description of it. Yeah.
Okay. And so when you were working in your business, you were focusing on the finance, you're doing the property on the side. On the finance side, what were you learning in that period then? I think you were probably in the market looking back, 1998 through to probably about 97. The market, especially in property for finance, changed quite a lot.
Yeah, it did. Around that time, the concept of a buy-to-let mortgage, which had never previously existed, sort of came into being, and that I guess revolutionised investing. When I first started back in the 80s, there was no system to work out. Lenders could not access if you already had a mortgage. So you just took out a mortgage and said, "I want a mortgage," and it was much more innocent times, really. But certainly the advent of buy-to-let mortgages was a catalyst for the sort of growth in the private rented sector that we've seen today. Also, the advent of ASTs was a dramatic shift on the landscape. Prior to that, you had regulated tenancies, and they were geared heavily in favour of the tenant, and the private rented sector during the 50s, 60s, and 70s had declined to such a point. There were a lot of slum landlords, and their justification is I can't earn a return on my on the rent I can get from my property, so I can't afford to spend any money maintaining it.
Yeah.
But the ASTs, which came into effect on the 1st of January 1989, dramatically shifted that balance. Some may say too far in favour of the landlord, because a tenant went from having a lifetime tenancy to essentially a 6-month tenancy that they could be given 2 months' notice on. So, but I mean, that's for other people to determine whether the pendulum swung too much the other way or about right. But certainly, it had its desired effect. The government wanted to reinvigorate the private rented sector, and ASTs did exactly that. And to the point where now, I saw some figures not too long ago that said 1 in every 5 mortgages granted is a buy-to-let mortgage.
Oh, wow.
And even 30 years ago, that would have been unthinkable.
And so what impact do you think that's had on house prices in general?
That's, I guess, harder to be specific on that because, again, if 1 in 5 is a buy-to-let mortgage, 4 in 5 are still residential. So the market is driven by the availability of residential mortgages, really, I guess. And, they've gone full circle, really, from being 30 plus years ago, ridiculously hard to get, very, very restricted. Banks weren't allowed to, at that point, weren't allowed to offer mortgages. Only building societies could do it. That got deregulated around the same time as the shift into ASTs. So that opened up the market a lot. I mean, if you go back, I don't know, probably about 40 years, the only way you got a mortgage was by saving with a building society for a few years. And once you clocked up enough time, they would give you, they would deem to consider a mortgage. But about 2 times salary would only take a man's income into account, wouldn't take a woman's income into account. It was all very misogynistic and archaic, really. But it was a practice that had pretty much grown up throughout the early part of the 20th century, and it took the mid 80s really to revolutionise and reorganise and bring it up to the latter part of the 20th century. But the increased availability of the mortgages, I think, fueled the increase in property prices.
Yeah.
And in the last 20 or 30 years, we've had a couple of crashes in terms of general property prices, and then they take some period of time to recover. So I think I guess if you want to sum it up in a nutshell, has the availability of finance increased property prices? Undoubtedly.
Yep.
Yeah.
Exactly.
So, yeah, you talk to people's parents or grandparents, and they bought a house for £4,000.
Yeah.
And I don't know, some 40 plus years later, it's worth 400,000. So has the free availability of finance influenced that? I would say unquestionably. Now the pendulum's swinging back the other way since the credit crunch. Lending practices have been tightened. Finance is harder to get hold of. And the key phrase now that comes down from the regulators is responsible lending. And they've been hammering home that message to mortgage lenders for the last few years. It's all about lending responsibility, and that means that they lend more prudently. So there isn't the excessive lending there was pre-credit crunch. That has reined things in a bit, I guess.
And so with the lack of availability of funding, how do you think that's changed in its impact to new investors? In the past, it was easier to buy property before pre-credit crisis, and prices were slightly lower. Both of those have changed now. So for a newbie, how exactly do you think the landscape is different, and how should they be approaching it differently?
Well, certainly what worked pre-credit crunch doesn't work post-credit crunch. So they need a post-credit crunch environment. I mean, there are several training companies around. I don't see any of them, to my knowledge, teaching stuff that doesn't work in today's market. So the training companies have adapted. Those that have been around before the credit crunch have adapted what they teach, because what worked then doesn't work now. So I think it depends at what entry level point someone comes into property. And that entry point is largely geared around two factors: available cash and provable earnings.
So just on that, I think let's take that example. So let's say there's somebody that's coming into the market, and all they have at the moment, I say all, but what they have at the moment is an existing residential property which they own and may have some equity in.
Yep.
So in that scenario, I guess, what would be the best approach, and how should they be approaching things differently versus what they would have done in the past?
Well, clearly it's more difficult to remortgage and pull equity out of a main residence than it was in earlier years, and that's tightened up progressively since the credit crunch.
And so what kind of difficulties will they face pulling money out?
Well, underwriting on main residence mortgages has changed. You could say for the good. It's certainly got a greater basis of logic around it now. In the early years after the credit crunch, you could take, let's say, someone with a 30,000 salary, just to pick a salary to illustrate the point. Now, they would be lent a multiple of their salary. Their personal circumstances would play the very little part in the amount of money they can borrow. If it was 4 times 30,000 or maybe 5 times 30,000 or something like that. Now, drill down another level and say, well, okay, in a minute, this person on 30,000, they're single. So, they've got quite a lot of disposable income. And then contrast that with someone, let's say, that's bringing up 4 children. And they've got the same salary, but clearly not the same disposable income. So, as anyone that brings up children will tell you, bringing up a child is not cheap. Bringing up 4 of them certainly isn't cheap. So, a good chunk of that 30,000 salary that's left after tax, national insurance and the like goes on bringing up, the cost of bringing up children, which a single person on the same salary doesn't have that cost. So clearly they have different borrowing capabilities. So, but these weren't distinguished, in the early years after the credit crunch, that the regulator corrected that. So now, for a main residence mortgage, lenders do start off with your salary, and they may well work on a multiple, but they factor in your lifestyle and make a downward adjustment to base it on that. So now, instead of being able to borrow pretty much the same, the single guy and the person bringing up 4 children would not have the same borrowing capability. The single guy could borrow more, or girl, obviously, could borrow more because they've got less commitments, less calls on their money. So it's more realistic borrowing.
Yep.
And then add to that they were the lenders are then now forced to factor in potential future interest rate rises and reduce the amount down again, so that people can cope with a few rises in interest rates without getting into financial difficulty. So again, all under the tenet of responsible lending.
And so for someone just coming into it, that sounds like two massive barriers which are basically impossible to overcome.
Well, it certainly means they can raise less money to pull out equity in their main residence than they could have done if they'd been investing, let's say 5 years ago. So, that's clearly the case. So that does make it more difficult. But in that time, what you've seen is I guess the growth of the controlling property genre rather than buying and owning property genre. So, where this is lease options, lease purchase options, rent to rent, all these types of things, they're mainly targeted at people that either don't have the income or don't have the equity or don't have the cash and haven't got the ability to do that. So, they're lower entry level ways you can get into property. An angle on that, which where bridging would come into effect, is that bridges don't lend based on income. They lend on an asset. So, someone that's got a big chunk of equity in the property that they couldn't get out because their income is sufficient could potentially bridge some of that equity on a short period of time and use that as deposit cash to get them into a deal.
Okay. So what you're saying is that before, when we're talking about the property for a newbie, if you have equity in your property, you're going to be limited in terms of how much you can borrow against it because of changes to affordability calculations. But from a bridging perspective, there are other ways around it because they don't look
Sure.
at affordability. Is that right?
Yeah, essentially so, because bridging is short-term finance, and when a bridger gives you a loan, they expect you to repay it within a matter of months, and they know there are two ways, only two ways that you can pay that, and that's either you sell it or you refinance it. Now there are multiple options under both of those banners or headings. There are multiple ways to sell a property. There are multiple ways to refinance a property, but essentially everything falls into either one of those categories. If you want to buy a property and make a profit on it, you either sell it and bank the profit, or you refinance it and get as much as your cash out as possible and take a drip feed income of cash flow on the monthly profit of the.
And so it sounds like one of the things the bridges are very interested in, even before they lend, is the exit strategy, how they're going to get their money back.
Yeah, that's right. They would need to be confident that you've got a robust exit strategy, and preferably a plan B too if the other one doesn't work. So sometimes people would say, "Well, I'm gonna buy this house, and then I'm gonna apply for planning permission to convert it to 3 flats." So a bridger would say, "Great, that's great. We're happy to support that. What happens if you don't get planning? Then what are you going to do?" So then they would want to see a robust plan B where you could still make money, perhaps not the same amount of money, but you can still make money.
Okay.
So bridges are very much in the business of finding out what your exit strategy is and making sure that actually it's viable. Again, another misconception about bridges is that they'll repossess your property as soon as look at you. That's actually with the vast majority of ethical bridges, it's not the case at all. They always reserve the right to do it, but that's no different to mortgage lenders. Mortgage lenders always reserve the right to repossess a property, and several thousand mortgage borrowers do get repossessed a year, sadly. So there's no difference there. But a bridger would view that as the last resort, and they would try and work with you if you encounter difficulties to try and get a resolution. So at the outset, before they grant you the loan, they want to understand that you've got a realistic plan A and as robust as possible plan B, that you're going to be able to pay them back.
And do they have a preference in terms of exit strategy, bridges?
No, not worried in the slightest.
So they don't mind if you sell or if you refinance?
No, not concerned in the slightest.
And so coming to the front of that, once they know what your exit strategy is and they're comfortable with that, what sort of things would they look at in terms of how much they'll lend you up front? I mean, say with a conventional mortgage, we're talking anywhere between 70 and 80% that you can get. What would a bridger be looking at from a purchase price perspective?
Yeah, bridgers tend to work on, I guess, maximum loan to values of between 60 and 75%. what would drive that maximum would be perceived risk. If it was a residential, then most of the time they'd be lending 70 to 75%. If it's commercial, because there's a greater perceived risk with commercial, they probably want to be at 60 to 65%, and possibly 70%. So that's it. Now, there is a fundamental difference in the way that bridgers calculate this lending. It's true to say that almost without exception, at the point of purchase, mortgage lenders take the view of, we will lend the lower of the purchase price or the value. So someone might have found a property for on the market for 100,000, and they managed to negotiate to buy it at 80,000. So the mortgage lender's valuer may come along and say, yeah, it's worth 100,000. Yeah, I can value this at 100,000. But the lender would say, okay, 100,000, 80,000, which is the lower, the purchase price of 80,000. So we will put our mortgage based on the lower of those two values. So in other words, it might be 100, worth 100,000, but the very fact you're buying it for 80 means you'll get, let's say, to keep it simple, 75% of 80,000, 60,000. So that's how mortgage lenders work at the point of purchase. The reality is the majority of bridges do exactly the same. But there are a bunch, not a big bunch, that will recognise that you can actually buy a property below its true current value. I hesitate to use the phrase below market value, because it tends to mean different things to different people. I prefer the phrase true current value. So it's not what you might make it into once you've done whatever it is you plan to do to increase its value, to forcibly appreciate it over a short period of time. It's what it's worth today. So, there are a bunch of bridges that are prepared to consider lending against true current value. Now, the upshot of that is, let's just use this as, again, the same numbers for ease of explanation. So you've got a property, the asking price is 100. You, for whatever reason, seller's motivated, whatever, have negotiated a purchase price of 80. Now, the bridges, under normal circumstances, you put down a 20,000 deposit, because 25% of 80 is 20,000. You'd expect to put down 20,000. Now, along comes a bridger and their value says, well, actually, yeah, it is worth 100,000. You're not paying 100,000, but it's worth 100,000. So what we'll do is we'll lend you 70% of the value, of the true current value, 70% of 100. Now, so you get a 70,000 loan, but you're only paying 80,000 for the property. So instead of having to put 20,000 down, you're going to have to put 10,000 down. And that's one of the unique things about bridging finance, is that it's possible to do that. So it's possible to do what I call shrinking the deposit.
Yep. And I guess in the example you just gave, you're basically putting down 100% less. You need to put down 100% more if you didn't use bridging in that example. So you've got two questions that come to mind then. One is, you mentioned below market value. And the mortgage companies ultimately take the position that the price you pay for it is the market value, because you're setting the market value by paying that price in the market. Yep. But then how could somebody get a property below its true current value? What sort of things could lead to that kind of transaction?
Yeah, I guess one catch-all reason, and that would be, someone that's motivated to sell. You could elaborate on that by saying that, I guess at any one time on Rightmove, there are upwards of 1 million properties for sale. And every one of those owners wants to sell the property. Otherwise, why bother to put it on Rightmove? Now, if you drill down another level, then every one of those sellers wants to sell their property, but there are a small proportion, probably less than 10%, that need to sell their property. And it's a crucial difference. So the vast majority of people will stick a property on the market and they're prepared to hold out for month after month after month to try and get their desired asking price. Sits there for 6 months, 9 months, 12 months. Okay, they can afford to wait. Now, for these small percentage of people that don't have the luxury of time, for a variety of reasons, they need a faster sale. And if they need to sell it faster, the thing that motivates buyers to buy quicker is a reduction in the accepted sale price. So, using those same figures again, because it helps to explain it, the property with the asking price of 100, 9 out of 10 people with an asking price of 100 would sit on that until someone came along and offered, if not exactly 100, but pretty close to it, maybe 97, 98,000. And they prepared, it would fit their budget for what they want to move on to maybe accept, a couple of thousand less. But, there are a small minority of people that even though it's worth 100, and even though they'd love to sell it for 100, they can't afford to wait for however long it takes to find a buyer at that level. So if they need to move quickly, they reduce the price. And this is not confined to property by any means. This is a universal truth. This goes for pretty much any commodity that you want to sell. If you need to shift it quick, you drop the price. So, and some people's situations are more acute than others. I guess you can look at pretty much any property training course, and there'll be a module or part of a module that covers this phenomenon. The common term is motivated sellers.
Okay. So you look for motivated sellers and you basically negotiate a price point that's good for them and gives you enough of a discount. Yep. Then you can basically reduce your deposit that you put down by executing a purchase against the true value as opposed to the agreed price. Is that right?
Yeah. In essence, it is, and, motivated sellers come in a number of different guises. And again, these are taught frequently on, I'd say pretty much, every base level property course. You would think that, it must be people that are in a sticky financial situation. And there are undoubtedly some of those. So it could be someone that's lost their job and they're getting behind with their mortgage and that nature. But there are other things that motivate people to sell at a lower price to get a quicker result. Unfortunately, it can be marriage or relationship breakups. It could actually be that one of the owners has recently deceased and the remaining person is struggling to manage financially the property of that size. So they need to downsize because they're existing on a lower income. It can be people with location issues. And there are a variety of those. People that need to move to a different area to take up a new job. People that need to be closer to family. And that could be people looking after aged parents, people wanting to be nearer their adult children and grandchildren to perform, babysitting type roles that would allow their adult children to work to a greater extent that would be the case if they weren't nearby. And people that are emigrating to a different country. And there are also properties that are no longer suitable for people's needs. So for argument's sake, you've got someone in a third floor flat in a block with no lifts and they've got mobility issues, which mean that actually on a practical basis, it's highly inconvenient, if not impossible, for them to manage 3 flights of stairs in and out. So they can become sort of, effective prisoners in their flat. Now they need to live on the ground floor, whether it's a bungalow or a ground floor flat or something. They need to eradicate stairs from their life. And their health may be such that to get that change in lifestyle, they're prepared to sell at a lower point. And I think, and again, there's another point that's made again by most of the trainers. I think that this is not about exploiting people, and it shouldn't be about exploiting people. It should be about creating win-wins. You get the property a bit cheaper, but they get to move on with their life. And that is a win for them. Yeah. Now, they would make a judgment on what actual purchase price made it a win for them. And most rational people can come to a conclusion on that basis and create something that, allows, take a price that allows them to move on with their life. So
I think, yeah, there's a ethical question there around buying something that you know to be for a price below its true value. But actually, as you alluded to, this is how trading works in general in the world. You have two
Yeah, it
people.
is. It's not property. It's not restricted to property. I mean, shops have sales frequently.
Yeah.
So why do they sell stuff cheaper than its real worth? Well, because they need to shift it out of their shelf and to make way for the latest product lines.
Yeah. And
So they'll sell, and the whole concept of January sales, goes back generations. But it's the same principle. If they could have shifted it all out at the headline price, they would have done. They're in business to make a profit. They're not going to just give away their products at a ridiculously cheap price. But there comes a point where it's no longer good business to have stuff sitting on the shelf that isn't shifting at full price. You need to cut the price, get it out, and replace it with better stock.
Yeah.
It's all the same sort of thing, really. It's just life in general.
And so looking out for those sales out there in the property sector, at least, and then using something like bridging to reduce the amount that you have to put down still leaves you, I guess, with a little bit that you have to find in order to make up that difference.
Sure.
I mean, is there, going back to the scenario, if we have somebody who owns their existing property, maybe they have a bit of equity in there, was there any way that they could use bridging to come up with a scenario that doesn't involve them finding any new money?
Yes, because some bridgers will be prepared to put a charge over their current property. So typically it'd be a second charge because their mortgage lender already has the first charge, so the bridger can't have that, but they will go second. And it can have the effect that you can do what I call a no hard cash down deal. In other words, you borrow 100% of the purchase price by taking the first charge over the property you're buying and a second charge over the property you already own. It's one loan spread across two properties, and cumulatively, it gives you the ability to borrow 100% of the purchase price. And as brokers, we arrange those type of bridging loans frequently.
That's interesting. And then what about the renovation cost and the cost associated to those? Is that something a bridger would consider?
Some bridgers would consider. Mortgage lenders, again, are a bit flaky on that. They tend to not lend. Okay. So you want to say, oh, well, I need to borrow £40,000 to do an extension, and they would say, well, you haven't got enough equity in your property to do that. Yes, but once I've built the extension, I will have the amount of equity of property, and it's one of those old chicken and egg type of situations, or catch-22 situations, to use a couple of cliches there, that they won't lend you the money because it's not worth it day one, and you can't make it worth it because you can't borrow the money to do the work.
Yeah.
So it's a self-defeating thing. So mortgage lenders generally are not particularly interested in that type of thing unless you've got massive equity in your property anyway, and that they can still lend it to you and keep within their lending guidelines. So some people have got that capacity, but a lot haven't. So bridges to an extent are the same. They won't. They're quite reluctant to lend on a currently non-existent future value, with a couple of exceptions. There are now actually, to sort of veer off at a tangent there for a minute. What we are seeing is certainly the time I've been involved in bridging, as my core broker in business, is we're seeing a maturing bridging market. So we're seeing innovative product developments that are actually pushing bridging forward, and making it a more rounded product genre. So, for example, we now have things like refurbishment bridges. So they're not widespread, but maybe 2 or 3 lenders would say, okay, what's it going to be worth when you've done what you want to do? So, for example, picking up an earlier example, what's it going to be worth when you've converted this house into 3 flats? So they'll lend you a proportion of the purchase price. So let's say 70% of the purchase price. But because you're going to add significant value, they'll lend you 100% of the cost of converting it to 3 flats. That would probably still equate to, no more than 70% of the end value of the 3 flats. But it does give you a way of financing it. So that's one innovation we've seen probably in the last couple of years. For any developers that are out there listening, then development finance for you to build your block of flats or your single unit build or your multiple unit build, can be quite costly, particularly if it's in what's deemed as a less than prime location. And the lenders with the lowest rates are not really too keen on lending where you want to do this project. So for most developers, it's a buy, build and sell model. There is, the variant again that's grown up in the property world of, build to rent, where you buy, build, refinance. But the majority of developers in the UK, it's buy, build and sell. Now, they've completed the build, but then there's a time lag of what can be several months whilst they find buyers and those buyers find their mortgages and that whole process goes through. Now, all the time, these developers are sitting on not inexpensive development finance. So, again, 2 or 3 of the more forward-thinking bridging lenders have said, well, there's not much risk here because you've got a finished site, you've got buyers line. Some might have exchanged, some might not. You don't actually want to borrow any more money. The investment part of the project is finished. Why don't we just give you a loan to pay off your development finance and charge you a lower rate of interest? So that's again innovation that's popped up in the last couple of years, and that's helping developers to increase their margin because they're able to decrease the borrowing costs of a development project. So just a couple of examples there of the way the bridging market is maturing. Refurbishment bridges and post-development loans really didn't exist 3 years ago.
And how prevalent are they now in the market?
Still a minority because still the majority of lenders in the market don't offer those facilities. But I guess they will get more widely available in the next year or two. Lenders tend to transcending property, anything in the world, people, was it the imitation is the sincerest form of flattery?
Yes.
Now, on a completely different tangent, I sort of stay in and work out of, quite a lot of hotels. And, Dyson in the toilet part of the hotel, Dyson, pretty much revolutionised the hand dryers with their blade drying.
Yep.
Now, that I don't know when that popped in, probably within the last 5 years. Going to hotels now, and you can see a similar, if not identical, hand dryer, but it ain't made by Dyson. Someone else has looked at Dyson's technology. They're in that sector anyway, and they've brought out their own variant, whether it's as the true equivalent of a Dyson or whether it's a slightly inferior model of a Dyson. They've taken they've seen what's working, they've seen what's selling, and they've produced their own version. So I don't expect bridging lenders to be too different from that. They'll follow the same thing, find something that works, and they'll bring out their own version.
Yep.
So I think we would see a duplication of those innovative products. And, and maybe there's more innovative products bridgers will bring out in the next 2 or 3 years.
Yeah, we hope so. Just want to draw back quickly on an example that you gave. Looking at bridging, what about if you already own the property? So let's say you already own the asset, you already have a mortgage on it, but what you want to do is that development piece and the mortgage company won't give you the additional funds and you don't have enough equity in to take a second charge, let's say, because you're at about 70% or 75%. How can bridging help you in that scenario?
I mean, again, if you're going to get yourself into a project, a bridger would always, one bridger, I mean, not every bridger would fund every project. Some of them just don't like the look, feel, the location, or whatever of a project. But there'll pretty much always be one bridger, no matter what your project is. So they would fund, as we said earlier, anything between 60 to 75%. If you haven't got the cash for the deposit and you haven't got the equity in any property that you own, then you've got to go into the private sector, really, I think, and look at private money, and because there will be people that have got the cash to put down as a deposit for you for a return, obviously, or people that have got equity in properties that they own. So you can bring sort of private money in there and use that to plug the gap, bridge the main purchase, and plug the gap.
Okay.
And actually, now that brings on another contradiction between bridgers and mortgage lenders. When you're buying a property, mortgage lenders are very interested in where your deposit comes from. And they will drill down level after level until they are comfortable that you are using your own cash, whether it's cash you've saved up over a period of time, cash you've got from selling a property, cash you've got from refinancing a property that you already own, but it's your cash. It's not someone's cash that you've borrowed, and it's certainly not someone's cash that you've been gifted. It's a not uncommon scenario that someone has borrowed some money privately and presented to the lender as, it's not a loan, it's a gift. And 10, 20, 30,000 pounds, lenders' views are, people don't give you money.
Not that amount anyway.
No one's going to give you 20,000 pounds. So, yeah, you have that money and you see what you can do with it. Don't worry about me. I don't need it back.
Yeah.
The only exception that mortgage lenders think is valid on that is parents.
Okay.
Parents will gift money to their children to give them a leg up in life.
And what about spouses?
Possibly, yeah. So it's someone with it's going to be a very close connection. What it certainly isn't is someone you happen to meet at a property meeting.
Yes.
And say, oh yeah, have 20,000. And they say, no, it's not a gift, it's a loan. We're not stupid enough to think that people give money away to other people unless they're extremely closely related to them. So if it's not your money, lenders will decline to lend, because mortgage lenders are very clear that they see borrowed deposits as a reason to decline a mortgage. And something that I guess there seems to be a lack of awareness around from investors I talk to is that once you've got your mortgage offer, you think, oh, well and good. But the lenders, prior to releasing the money, do another sweep. They do another credit file check, because they want to see if you've suddenly, after you've got your mortgage offer, taken out another unsecured borrowing. And if you have, they say, hang on a minute, you're borrowing the deposit, or we suspect you're borrowing the deposit. We don't allow you to do that. Therefore, we're pulling our mortgage offer. So having your mortgage offer pulled after you've exchanged contracts is not the most comfortable place to be.
No, probably the worst place to be in a property deal.
It would be, absolutely, yeah. Deposit originates from, and make a judgment on that relative to whether they'll lend or not. Bridgers, on the other hand, are far more relaxed about that situation. So they're far less concerned if you have borrowed the deposit money, because they know they're going to get their money back. Either you're going to sell the property or you're going to refinance it within a matter of months. So they're much more liberal about the source of deposit money. Now, it may be that a bridger says, well, the person putting up the deposit money has to come on the loan. That's not unheard of. So you've certainly got more flexibility using other people's money with bridging lenders than you have with mortgage lenders. I think that's the point I wanted to get across there.
Okay, and I think you got that point across very well. So before I let you go, Kevin, I just want to ask you a few questions. I'll ask you some quick fire questions.
Sure.
And hopefully we'll get some good answers to this. But you mentioned, you've trained thousands of people, or over 1,000 people. What's the biggest barrier you think people have to executing some of the great knowledge that you've shared with us today?
Fear, procrastination, I think, are things. And I don't for a minute think that's limited to my training. I think, any trainer would, and again, not just limited to property, but we're dealing with property, but it's not limited to that, is that people routinely come off of one training course or another they've been on, fired up to take action, and then real life intrudes. They're back into their normal grind, and most people lead busy lives in varying degrees, from extremely busy with the old cash rich, time poor type of scenario. So it's very easy to let the enthusiasm that you've got over a week or a weekend's course dissipate as real life kicks in. And I guess the longer the gap is between the learning and trying to take action on it, there's what factors in knowledge fade, so that we become, it's on the time we get the learning, it's very clear in the forefront of our mind, but we gradually over a period of weeks and months lose some of that clarity of understanding. So it becomes a bit foggier, and now we're not 100% sure of what the strategy was that we learned. And when we try and implement it, there's a couple of bits that we can't remember, and these are key component parts. And we become fearful, I think, of making a mistake. So it's that polarization of, if I don't do anything, I can't make a mistake.
Yeah.
So I guess that's, that's the, and I think a nice counterpoint from that is Rob Moore from Progressive Property Organisation, has a lot of insightful comments. One of his in this instance is that where he says, if you risk nothing, you risk everything.
Yeah, that's very true.
So, if you never take any action, well, what you risk is all your hopes, dreams and aspirations ever coming to fruition.
Very true. Opportunity cost, is it? No. Okay,
yeah.
Next question. Based on what you've just said, actually, and being someone who's done courses for quite a while now, what do you think people should look for in a good training course?
I think they should look for the material that's supplied. So there should be some form of written version that they can take away with them. So, to look at the one end of that spectrum, if you turned up on a training course and there's no written material, your only way of recording it, the information that you're getting, is for you to write it down freehand. I think that puts you, the participant of the training, at an enormous disadvantage, because you've got to listen to the speaker, understand, objectivize, analyze, and then write down everything that is being verbalized to you in a way that you're able to understand, decipher, and pick up again at a future point when you need to reference it. And I've got to say that is an extraordinarily difficult task, because most speakers speak at a speed that is way too fast for you to fulfill all of those functions in any meaningful way. So I would say you need some form of written material that puts the very basics of the course learning. Even if you go through it with your highlighter pen, or you add little bullet points in appropriate places to enhance its meaning to you personally, you need to ensure that there's some written material there to impart combat knowledge fade. And one other thing that I think it would be important is that there is post-training support.
Yeah, that's very good. I think both of those things actually are the benchmarks of any good course, in my opinion.
Yes.
If a course doesn't offer that, then you shouldn't be taking it. And actually, in this show notes, I'm going to link to your training program, which, in my opinion, stands above most of what everybody else offers. Mainly because, like I said, it's very niche, and that's where the money is really, in the niches. But also, I'm a financial professional, and I learned a lot about finance from your course because it's so niche and because you're so specialized in a niche subject. So, I have to thank you for your time today.
I think that's very cool. I think there's a way of characterizing it. There's a lot of property education courses around, and a lot of good ones too. But they tend to be more, certainly at the base level, more generic and wide ranging. I've heard the description. They're a mile wide but an inch deep. And that's not necessarily a criticism, because there is a need and a demand for that type of course. Now, my training programs, and that's whether you come to a live workshop or you get any of the distance learning materials, either visual or audio, that I provide, it's on one specific subject, and that is how to creatively, legally finance property purchase with minimal input from yourself financially and maximum speed at turning that round. So it is nice, it is detailed, and the contrast would be it's only an inch deep. It's only an inch wide, but it's a mile deep.
Yeah, I agree. I mean, I totally agree with that. But I would go as far as to say the courses that are, an inch deep and a mile wide, people shouldn't really be paying more than, 20 quid for that type of content, because there's so much of that out there for free via YouTube, websites. People have to put that content out, the mile wide content, basically to build credibility and to build their own profile. So there's lots of that stuff out there. It's the stuff that's a mile deep. That's really where, whether that's on rent to rent that you mentioned earlier, a core strategy control, whether that's on bridging, a core finance, or whether that's on HMO, something core, those pillars, I can understand that if you find a good course, you should pay for a good course, what it's worth. But, the stuff that goes across, I think there is a lot of that in property. The thing that people complain to me about is that a lot of these courses are basically upsells onto other courses. And that's where, there's some challenges in the perception.
Yeah. And there again, I think it's all relative. It's not necessarily a bad thing to be offered a higher, more in-depth level of learning, as long as it's accompanied, I think, by two things: enough usable content in the course that you're currently paying for to give value for money, and secondly, that whatever is the next level that you could choose to go on to, it's not oversold. So, I think people, it's fine for people to be given the opportunity to buy, but that's different from making you feel awkward about not, and even worse, ridiculed, because you're not buying.
Yeah.
And also, I think the last point on that would be the percentage of the course time devoted to guiding you to buy the next product. If it's a relatively small percentage of the course time, that would seem more acceptable than, let's say, I don't know what, half a day spent convincing you that you should be doing the next course, the next higher level that's usually at a higher price.
Yeah.
Intrinsically nothing wrong with offering a deeper level of training for a higher price, but it's all relative to how it sits within the course. So it shouldn't take up too much time. You shouldn't feel uncomfortable or be ridiculed if you don't feel that is the right step for you. Not necessarily forever, but just right, not now. And it shouldn't. And the current course that you're paying for shouldn't be light on content just to provide that as an extra incentive to get up to another level. So it can be done well and it can be done credibly. The reverse is also possible.
That's great feedback. And I think my last question for you, actually, before just bringing it back to bridging before we leave, one I wanted to ask earlier, question I get quite often. People say bridging is expensive. How expensive is bridging?
Yep, I would say that's an old saying. If I had £1 for every time I heard that comment, I'd be a fairly rich man. Well, my view on it is that you can never say bridging is the cheapest form of finance. It isn't, and it's not meant to be. But it's all relative. And here's the point that almost everyone misses. It's not about the cost, and it's certainly not about the cost in isolation. It's about the opportunity. Now, on the first morning of the live workshops that I run, as you may recall, one of the questions I asked the delegates there is, I've got an opportunity here for you to earn a £50,000 profit on a project. However, I need you to give me £10,000 to make that 50. Are you prepared to do it?
Yes.
Yes. And almost everyone says, yes, I'll give you 10,000 to get 50. Now, and that's not me actually offering you a real project. It's offering you it's highlighting a situation. Now, essentially, bridging is no more complex than charging you £10,000 to make a 50,000 profit. So it's not about the £10,000. It's not necessarily about can you readily borrow the money for that project at less than £10,000. Because if it's a mortgage and you can't get a mortgage, the alternative is not there. If Bridger will lend and a mortgage lender won't, it becomes a question of, not should you finance it, but what profit would you make? If bridging is the way to get into a significantly profitable project, then you could choose that it's a price worth paying.
Yeah. And I think one thing I always say when people tell me bridging is expensive is so is opportunity.
Yes, that's a very good position on that as well. Yeah, it's another way I characterise it. It's a bit like picking up a telescope and by mistake looking down the wrong end. What you see is is the cost, but what you fail to see, which is at the other end of the telescope, is the opportunity. And sometimes these are massive opportunities, and people walk away from them because they're so fixated on the cost. The other thing, one other point to finish up on bridging, again, the big mistake people a trap that people can fall into with bridging, it's not a mortgage, it's a different kind of finance. It's more creative, it's more adaptable than a mortgage, but they try and bolt it onto their negotiation process, which is all geared around getting a mortgage.
Yeah.
Yep. Now, contrast those people that buy with a mortgage that those people that buy with cash. Now, do you think that a cash buyer is a tad more aggressive or a tad more tougher in the way they negotiate to buy anything, not a property? Again, this transcends property, than people that are finance dependent.
Definitely.
And most people say yes, great. So, if bridging elevates you to more up to the level of cash buyer, then it's a mistake to not adjust your negotiation strategy, away from how you would negotiate if you're restricted by a mortgage, and more in line with how you would behave if you had the cash in the bank. And most of the teaching that I do is around that basic premise. It's about learning and adopting and implementing the behaviours of a cash buyer around property, knowing that bridging gives you the ability to mimic most of the things that cash buyers do, the way they act, the way they think, the way they negotiate, the types of properties they buy, and often the profits that they make.
And how quickly they can complete deals.
That's part of it. Yes, that's right. Because bridging done correctly, way faster than mortgage lending.
Fantastic. And on that beautiful tip, Kevin, thank you very much for your time today. I'm sure we're going to catch up again soon, but one day we'll bring you back on the podcast as well.
Yep. Very happy for that.
My pleasure. And we'll link, as I say, to everything that you do in the show notes so everybody can contact you and get additional information. But thank you and have a good day, Kevin.
Okay. Thank you very much, Crazy. Good to see you.
We hope you enjoyed this episode. If you'd like more information on what you just heard, go to slowmoneyclub.com and join the club. Don't forget to subscribe on Apple Podcasts, Spotify, or whichever app you use. And please also give us a 5-star review. That way, you get the latest episode on your phone as soon as it's released. You also help other people discover this podcast too. Thanks for listening, and see you next time on the Slow Money Club.